Hey guys, so today's webinar is going to be about 10 trading do's and don'ts. So, what we're going to talk about is some common mistakes that traders tend to make, or actually, I shouldn't call it common, let's say key mistakes that traders tend to make. And we're going to basically mention how we could avoid these mistakes and what we could do instead of them, right? So before we go forward, let me quickly introduce myself. My name is Krikor. I'm a key account executive at IQ Option. Now, this is a new format of webinar. So this is an experiment we're doing right now, and we would love your feedback if you do enjoy it in this way. Basically, it's not exactly live, so you won't be able to ask any questions, but the benefit here is that you're going to be able to access it at your convenience whenever you like. Um, if you do have any questions, please feel free to ask your account manager, and I'm sure he or she will be very happy to help you out with that. All right. Now, also, quick disclaimer: I will mention some technical strategies. I will show certain things on the platform, certain entry points, exit points. So, if you're interested in trying out the things that I will mention, please try it on the demo account first. This isn't to be seen as financial advice. This isn't necessarily my opinion or that of IQ Option. So if you like anything, please try it in a risk-free environment, and then you can do with it as you please. All right. So let's get started. 10 trading do's and don'ts. The first point I'm going to make might be a little confusing at first, right? First point is don't try to make money. Now, before you get up and leave, just listen to me for a second. I know this might sound a little beside the point, right? We're all here to make money. We're trading to make more funds. But I have a point with this. Now, if you go on a trading platform with the intent to just make as much money as possible, what's usually going to happen is you're going to just do things without thinking strategically, right? If you're just money hungry, more mistakes could potentially be made. Now, it's normal to want to make money. You should want to make money. If you don't want to make money, you're probably not going to succeed. But the point here is that in order to achieve making more money, you probably need to focus on doing your best to analyze the market. All right. Trading is about understanding the market conditions. Whatever assets that you are interested in, you need to do your best to understand the direction of this asset, right? Is the value going up? Is it going down? Why is it going up? Why is it going down? If you can understand these things, then your trades will most likely be in a better situation. And this will allow you to make, hopefully, more money than if you were to do it without the analysis part, right? So let's take a quick look. I'm going to direct you to the IQ Option platform here to show you the difference between something that has an analysis and something that doesn't. So let's look at the dollar Canadian currency pair right here. Now, if you just take a look at this right now, right, I have an area chart, no any real technical indicators, nothing like that. Um, there's not a lot you could say, right? If you just look at this right now, what can you really say about the value of the dollar or the value of the Canadian dollar? It's not much to work with. And if you're just here to, again, if you're money hungry and you're just trying to make as much money as possible without thinking about anything, you can just, buy, sell, and it's not going to lead to anything, right? So let's take a look here. Here, the first thing you'll notice is that there's a couple of technical indicators, and also I am using candlesticks instead of an area chart, right? So what can we see here? We can see two different trends. First of all, we can see that the movement of our candles right here is below a moving average line, right? Now, I'm not going to go too into detail about the set indicators and how these strategies work. So again, if you want more detail about this kind of stuff, do contact your account manager. What I'm going to show you today is more basic points to understand the differences in the right choices and the bad choices. So again, as I was saying, candlesticks are below the moving average line, right? Here we have an understanding that we have sort of a long-term downtrend on the dollar CAD, right? Relatively long-term. These are 1 hour candles. If we zoom in here to our oscillator, the relative Vigor index, we can see that there is a shorter term uptrend within the long term downtrend, right? So, what does that tell us? That can potentially tell us that even though it's a downtrend, and even though you might be interested in shorting the dollar CAD, right? You might see the downtrend, you might want to go into it. This right here could be telling you that, wait, it might not be the best time to go into it because this indicator right here is telling you that there's a short term pullback upwards, right? So compare that to this. This tells you nothing. This tells you there's a downtrend and might not be the best time to go in, right? What could you do? You could wait. You could wait until this here agrees with this here, right? Now that's a very, very, very basic analysis. But again, I'm not going to go too into detail about that. This is just to show you that there are two ways of doing this. There's actually, well, many ways of doing this, but we have to differentiate between an analysis and a lack thereof. All right, cool. Let's go to our next point. Don't trade blindly. Um, when I say don't trade blindly, I mean, look, you could always go on the platform and you could set up a technical analysis like the one I just showed you, and you could look for trades, right? But the thing with technical analysis is that it can show you movements, it can help you understand future trends or understand where it's going to go, but it doesn't exactly explain why these movements are happening. And for us to for us to get a better understanding, right, of why the market is moving, to get more of a predictive understanding of where things are headed, we do need to read market news, right? So don't trade blindly. Do read market news. Now, there's obviously many, many ways you could read market news. You could just go to Bloomberg.com and I don't know, say you're interested in oil, right? You can just write oil, Google oil, see what's happening with Brent. You'll always find something that could help you understand why today might be up or why it might be down or why it's trending, why it's ranging. It's really important to kind of read these things before you go to the platform to make your trades. And I'm going to show you an example again, a very basic example. I'm going to direct you this time to one moment here. Let's go from here. So I'm going to direct you to a website. Now, this website is called forexfactory.com. I'm sure most of you have heard about this, but just to make a point here, I'm going to show you something. So today is Friday. We are currently 11:37 in my time zone, which is GMT +3. Now, if I take a look here, we see that we have a few macroeconomic reports that are released that could affect many different currencies. Let's take a look right here, 3:30 p.m. Today we have a few for the Canadian and the US dollar. Why we are focusing on these ones? Because they are high impact reports. Now, a high impact report means that it is very likely to affect the market. So come 3:30 p.m., again, GMT +3, you should set this to your own time zone. 3:30 p.m., there is likely going to be a lot of volatility with any pairs that are associated with the Canadian dollar or the US dollar. All right. So what do we have? We have employment and we have unemployment, right? For the Canadian dollar. For the US dollar, we have, again, employment, the NFP, and the unemployment again. And then we also have average hourly earnings. Now, explaining the different implications of all of this could be a whole discussion by itself. It's a whole lesson in economics. I won't get into too much detail, but um, to put it quite simply, right? These kind of reports can obviously affect the currency of the country they are reported for. Now, we have forecasts here, right? And we have the previous number as well. So let's take the example of the non-farm employment change, which measures the current levels of employment in the USA, right? We can see that last month we had 75,000 more people employed, excluding the farming sector in the States. The forecast for today is 162,000. If you're unfamiliar with the word forecast, that means it is the analyst expectation of the number that will show up here today. Now, it's all empty here because this hasn't happened yet, right? All of this here has happened. So, to kind of show you the kind of impact these kind of reports can have on the platform, let's go back a couple of days and find something to look at. On Wednesday, July 3rd, we had the ADP non-farm employment change. Now, this one is released a couple of days earlier than the actual NFP, and it gives us some kind of idea of what that number could be, if it's going to be a positive number or if it's could be a negative number. As you can see, the number was 102,000, which was quite a bit less than 140,000 forecasted. So let's go back to our dollar Canadian. And I'm going to dollar Canadian because obviously this is a dollar pair and the NFP is going to affect the USD, right? Let's check the time again. That was July 3rd, right? At 3:30 p.m. No, sorry, at 3:15 p.m., right? Again, this is GMT plus 3. If you're going to check this from your side, please apply everything to your own time zone. So we have July 3rd, 15:15. Let's put 15-minute candles to get a better view. There you go. Look at that. Look at that drop, right? Negative report for the USD. Employment is not as great as expected. Mind you, there still is employment, right? It still has, it's still more employment, right? There are still more people employed, but not as many as expected and not as many as was forecasted and not as many as they want. So this happens right here. Price drops. Now, this is really important because if you had some indicators here, let's say you had some other indicators that told you, oh, look here, right here. Look at this right here. The relative Igor index here would have told you that we are looking at an uptrend, right? It tells you here to buy, but the relative Igor index cannot follow economics. It doesn't understand economics. If it sees the numbers, it's not going to tell you if it's good or bad. All it can do is look at historical data. So all of this is going to take into consideration, but it cannot foresee this because it doesn't know about the NFP. It doesn't know what's really happening in the real world. It's just a statistical algorithm, and that is going to hold you back from being able to see what's really happening. So in order to predict this right here, you need to follow market news. All right. Now, let's go to our next point. So, don't try to recover your losses. Again, at first sight, you might think, why wouldn't I try to recover my losses? If I lose money, I want to make it back. Sure, you should, of course. But there's a difference between recovering your losses and minimizing your losses, right? Now, I bring this topic up because I feel it's quite important considering the fact that this gets requested by clients a lot. How do I make back the money that I have just lost in trading, right? And one of the biggest culprits of this whole strategy to make your money back that kind of doesn't fix anything is the martingale strategy. If you haven't heard of the martingale strategy, the martingale strategy basically has you double up after you make losses. So let's say you put 50 bucks in a trade, you lose that, next one you put 100. If you lose that also, you put 200. If you lose that, you put 400, right? So you keep doubling up with the hopes that at some point you will win a trade and you will make back the money you just lost. But think about that for a second. Think about what I just showed you before this slide, right? We looked at ways that we could analyze the market. The strategies that we were looking at had some kind of merit behind it. We were reading things, we were understanding things. There's no level of understanding in this kind of approach because this kind of approach is not a trading strategy. Martingale is not a trading strategy, it is a betting strategy. So it relies on a gamble, it relies on luck. And if we are relying on luck, then we're not really trading, are we? We're gambling. So this is very important to distinguish. Martingale is not a trading strategy. You have to be very, very, very careful when it comes to investment amounts and what you're going to do when you have made losses. Sure, you have to minimize them. So let's say you put $50 in a trade and you lost it. There's no shame in putting 50 again or even less, right? There's no shame in taking a step back, closing the computer, going outside, taking some fresh air, coming back tomorrow. There's no shame in that. You don't have to make all the money back. I understand why you would want to do that because obviously you get upset when you lose money, but that's all going to depend on how much you can control yourself in that moment. So my advice on that is live to fight another day. And if another day doesn't have to be the next day, it could be like an hour later. It doesn't necessarily have to be the next day. The point is that, don't try to make all that money back straight away because what's probably going to happen is you are going to make further losses, right? All you're doing in that case is you're just adding risk and risk and risk and risk. I mean, think about it. As soon as you lose money, right, the first thought that goes through your head is that you're upset, right? You go into a negative state of mind. As humans, whenever we're in a negative state of mind, we get this kind of impatient impulse to go to a positive state of mind, right? So, with this impatient impulse, what you're going to probably end up doing is making a trade that wasn't as strategic as it needed to be. So this not so strategic trade is already at higher risk, right? Because you're not as focused, right? So that lack of focus and the impatience is a higher risk trade. So if it is already a higher risk trade, what you're doing now is you are adding more risk by martingaling it, right? So that's just adding up the risk, 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 risk. And at some point, you are going to reach a certain level of risk to reward ratio that you would never be comfortable with, right? It's too much risk. It might be way too much risk for you to trade with, but due to the increased emotions, it's what you have come to. So you have to be, again, very careful with this kind of approach. Minimize your losses. Don't try to recover them straight away. So our next point is going to be about targets. Don't set targets to push yourself. Again, you might say, why? Targets are important. Yes, targets are very important. Um, but depends on what they're set for. Now, there's a difference between setting targets to push yourself and setting targets to restrain yourself. And let me explain. So, let's say that you have a target for today, that you have to reach an X amount of profit, right? Everything's going great. You're trading, you're making some profitable trades, whatever. All's good. Now, the end of the day has come and you haven't reached the target yet, right? You had decided prior to set a target so that you reach some great destination you wanted to get to, but today's target hasn't been reached quite yet. So what you're going to do, well, what you might end up doing is you might end up making trades that didn't need to be made. Okay, so if you do this, you're kind of putting pressure on yourself to make more money, and that pressure might force trades. And if you're forcing the trade, then that probably means there wasn't a real analysis behind the trade. Because if there's no real analysis behind it, again, it's not really a trade, it's a gamble. So setting targets to push yourself could be a very dangerous thing. Now, setting targets to restrain yourself could be a very positive thing if done correctly. Think about it this way: a way to restrain yourself could be to set targets that are lower than what you might normally achieve in a day, right? Um, again, as an account manager, I hear this from clients all the time where they tell me they've done really well the whole week, but then they got carried away because just like when you get upset when you lose money, right? You get greedy when you make money. Again, human beings, it's in our nature, but we can always do our best to fight that. So if you're getting greedy and you're making more and more and more trades, right, you have to have something that stops you so that it doesn't ruin the flow you've had so far. So think about it this way. One way to set targets, right, to restrain yourself is if you think of both long-term and short-term goals. So let's say this is just random example, right? But let's say your long-term target is in, I don't know, a year from now. 1 year from now, you want to buy a car and it costs, let's say, 20 grand, right? Um, you now can divide this number by 52, right? If it costs 20 grand, you can divide 20 grand by 52, which is the amount of weeks that is in a year. Now you know how much you need to make per week. Divide that by 7. Now you know how much you need to make per day, right? And what might end up happening is that the number that you need to reach could be a lot lower than what you thought you had to make in 1 day. So let me use a calculator. So 20 grand divided by 52, that's 384, right? Divided by 7, that's $55 a week. Now, I'm not telling you to put a target of 20 grand and $55 a day, right? I'm not telling you to do that. I'm just, the point I'm making here is that, well, most of the traders that I've worked with, $55 a day, they would have never actually been happy with it. They would have said that's not enough. But if it adds up to your long-term goal, if you know that 55 today, tomorrow, the day after that, all adds up to where you want to be a year from now, then it might hopefully potentially um, restrain you so that once you reach that small target you have for the day, you don't feel like you have to go above and beyond that, right? And this phrase gets said a lot. It's a marathon, not a race. Sounds silly, but it's true. It will all add up, right? Little by little, you will get there. So let's go to our next slide. Don't stick to just one setup. Now, um, earlier I showed you the technical analysis on dollar Canadian, and that was one setup, right? I had a moving average there with a relative Vigor index, and I was looking for entries into a long term by looking at the shorter term reversals and trends, right? That's one setup. There's no reason why you would stick to only one setup. You could always use a multitude of different analytical tools. All right. Um, you, you can have templates. So let's go back to the platform and I'll show you what I mean. So here on my dollar Canadian, we can see that this is one setup, right? If I go to indicators, I have templates here, and you can see I have three different templates. Pullbacks on trends is the one I have currently on. Then I have the overbought and the oversold. So if for example, let's say in the previous setup, I didn't currently find an entry point. I can check a different setup. Maybe there's something, if these indicators might tell me something different. What is this telling me, right? If you're familiar at all with Bollinger Bands, RSI, and Stochastic, you know that these indicators are saying that the price is reaching a bit of an overbought level, right? It's going a little bit high, which could potentially throw it back down a little bit, right? It's not there yet. It's not there yet, but it's headed there. So the previous setup was telling me that it was a downtrend and it was going back up, right? This is telling me now it's approaching an uptrend, isn't it? It's approaching it. But the other one, the other template here, overbought and oversold, is telling me that uptrend could turn back down, right? So it's always a good idea to look through different different setups, right? One setup might tell you one thing, the other might tell you another, and then perhaps you combine two or three setups, they might actually all push you in the same direction. And if all of them are pushing you in the same direction, then you find yourself in a situation where, well, okay, if all these different statistical algorithms are all agreeing with each other, then the likelihood of the trade being accurate is obviously higher, right? And that's what we're doing with technical analysis. They can all be useless and they can all be great if used correctly. The more of them are giving you the same signal, the more on point your trade could be. So that's why it's always a fantastic idea to use as much of it as possible. If you're going to rely on the technical analysis, don't stick to just one or two indicators. Use as many of them as possible to make educated decisions before you make trades. Going back to our slides now. Um, Next one, we are going to talk about making up for lost time. This is one of the most frequent conversations that I have with my clients, and it goes like this. I go in their trading history and I take a look and I see that during the hours of 7 to 9 p.m., for example, random times, but anyway, I see that during these 2 hours, there's a lot of trading being done. The rest of the day, there's nothing. But within those 2 hours, there is so much aggression in the trades. Hundreds of trades, dozens of trades at least within 2 hours, right? 1 minute options, 5 minute options, forex trades with 1,000 leverage, just so much. And you can clearly immediately see that this trader is trying to make as much money as possible within that period of time. They might be using some kind of analysis, uh, but they're really going in aggressively, right? And this is one of the greatest sins in trading, trying to make up for lost time. Usually the reason for this is because the trader did not have time throughout the rest of the day to make any trades, right? So what they're doing now is during that period of time, they're trying to make up for it. They're trying to make as much profit as possible within those 2 hours. Um, and when I bring it up to them, they say, but I have no other choice, right? I don't have any other free time to do this. Well, that's not technically true. You do have a choice. You can play around with this. What you can do is you can always set pending orders, right? If you don't know how to do that, let me show you. Let's go back to the platform. Right. Let's take a look at Bitcoin. Now, Bitcoin's been on a rise, right? It's been on a rise and it's attracting a lot of attention again. But let's say that you look at these candles and you tell yourself that, okay, I don't want to buy it right now. You say, I want to wait for it to come back down here. I'm not telling you to wait for it to come back down here. I'm just saying, let's pretend this is the analysis you've made. And you tell yourself that once it reaches down to 9.5, that's when I want to buy, right? Well, you can click right here. Look at that. Pending position. Buy. See? Done. When it reaches here, the trade will go through by itself. You don't have to forcefully enter yourself into investments right now if it's not the correct time to do so. All right? It'll do it by itself. Look, total portfolio pending right there. Bitcoin. Buy at 9.646. Right? Great. Problem solved. You don't have to make as many trades as possible in that time frame just to make those profitable trades that you want. It doesn't all have to be crammed in one place. And this goes back to the first slide. Instead of making so many trades, why don't you spend all that time analyzing the market? If you find something, right, you open a currency pair, I don't know, in Forex, you go on pound against dollar, right? You say, okay, I think at this point it would be a great entry. You say that I think that once it comes back here, it's going to go back down. Okay, pending order. That's it. Pending position, sell, right? You don't have to do it all right now. You can set the targets and the trades will go through by themselves. And once you do that as well, you can even edit your order. You can put a stop loss, right? If you think that if it goes back up here, for example, you want the trade to close because you think it's not gonna go. You think if it surpasses that, it's gonna keep going up. Sure, you know, set your stop loss. Asset price equals 1.25881. 1.25881. Done. Apply. There's your stop loss with your pending order, right? And Again, this is really important because what this could do is this could kind of teach you to be a little bit more patient. If there are no trades to be made now in the moment, don't make them. Set up future trades, right? You don't always have to live in the now. You could look at the past, you could analyze things, and you could try to see where they are headed. Prepare for what's to come, not only what's happening now. Now, this is also an important point. Skipping the learning period is again something that happens quite a lot. Now, I've already shown you a few things you could do, right? I've shown you a technical analysis. I've shown you fundamental analysis with Forex Factory, uh, pending orders, this and that. All of this requires learning, and all of this can be learned on the demo account, right? You need to educate yourself as much as possible before you enter real funds. And there is a reason that we have a practice account, right? It's for you to learn things. And this usually is a matter of impatience, right? Usually, when traders enter a trading platform, they are ready to make money, right? They are ready for it. They are ready to become millionaires. And they don't take the time. They don't take the time to educate themselves and spend some time trying out whatever strategy they're going to use on the practice account to make sure it can be consistent, to make sure it works for them. You have to practice things. It's all too often this happens with my clients as well, that like they'll ask me to show them a technical analysis strategy. I mean, I will, and instead of trying it on the demo account for a few weeks, at least a few weeks, by the way, one evening is not enough, you need to spend time with it. They'll go straight to the real account, and then they'll complain that it doesn't work. But if you give it time, if you try it on the practice account, you might learn from it, right? You might understand what works and what doesn't work. And if you can't make it work on the practice account, there's no shame in it. It's just not the strategy for you. We can try a different one. You can find yourself a different one. Um, Everything must be practiced. This is real money. You cannot try straight away on the real account. You can't immediately put real money into this. You have to be very, 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 very careful, right? Now, this will link directly to what I just said in the previous slide, which is not to be upset about losing. Sure, it's normal to be upset about losing. I mean, it's expected. It is losing money after all. But again, if you're doing things on the practice account, what you learn is you understand what you did wrong, right? So you get to learn from it and make the best of a bad situation. Now, again, let's say you're trying some kind of strategy, right? Let's say you found the strategy on YouTube and you went straight to the real account and you made the trades as the strategy would recommend you to do, and you lost, let's say, 3 out of 5 trades, and you're really upset. What's going to happen now is probably you're going to end up trying to recover your losses, right? You're going to invest more, you're going to keep trying, and you're just going to get more and more upset. One loss is going to lead to another, to another, to another, and you might go through an entire balance like that, or more and more investments, right? Um, However, if this new strategy you were to try it on the demo account, for example, what happens now is that as soon as you make a mistake, you can analyze that mistake, you can learn from it. It's often quite hard to learn from your mistakes when they cost you so much, right? And I mean, this can apply to anything in life. So when something costs you something, it's hard to look at it as uh, as something you're gonna make the best out of a bad situation, right? It's hard to learn from it because you're too emotional in that moment. And when this happens in trading, especially, you get upset that you've lost funds, and you just try to recover them rather than sit back, grab a notebook and a pencil, and write down what could have caused that bad entry. And when you think about it a little bit and you learn the potential error in what you've just made, you now will restrain yourself from doing it again. And this way, you get to learn. You can't get good at something without failing first, right? You always have to make mistakes to learn. But when you're making the mistakes in such a high risk environment where so much money is on the line, then it's really hard to learn from these mistakes. And that's why everything should always be practiced on the demo account. And this is a great way to not get upset about losing. Now, even if you did the whole practice thing, you followed a great strategy, you went to the real account, and you still made some losses. At least now, you've had enough work with it so that you're going to understand what you did wrong, right? The difference between going through the whole practice session first and not doing that is the fact that one, you're gonna be kind of dumbstruck by what happened, and the other one, you're probably going to understand the error. Okay, so that's why it's so important to always try things in a safer environment. Uh, Now, don't invest money that you can't replace tomorrow. This needs to be said because a lot of traders, what happens is they find themselves um, taking a loan or just putting a huge amount of money that they want to grow, right? And this, what it does is it puts you in the kind of situation where you're possibly dreaming too big for the moment, right? Now, it is important to dream big. It is important to have huge goals. I always say, if your goals aren't so great that people laugh at you when you tell them that they're not good enough, but you have to approach it in a smart way. Um, when you invest money, right, that if you lose it will immediately be bad for you, you shouldn't be investing in investments are not made with your savings. Investments are not made with your disposable income. Investments needs to be a separate pool of money that you have. Uh, there's a book called Rich Dad Poor Dad where this guy Robert Kiyosaki, he mentions you need to have a separate pool for everything, right? The money that you need to spend is its own thing. The money that you need to save for a rainy day is its own thing. The money that you use for investments is its own thing, right? You have to separate them, and you have to kind of build up that amount that you're going to invest carefully, right? So don't be shy about starting small and progressively building it up. You know, um, Again, a phrase that's often said: "Rome wasn't built in a day," but it's true. It wasn't. Things take time. You don't need to become a millionaire in one day. That doesn't happen, right? Don't be that guy who, as soon as he makes a lot of money, immediately goes and buys a Lamborghini. Don't be that guy. you know who was it? Grant Cardone. He's a guy who's huge into real estate. I watched a video of him once. He was saying, don't be that guy who immediately, as soon as you make a lot of money, you go buy Gucci belts and all this and that. Put your money in a place where it can make you further money, right? So save this money in a way that you can invest it, and then do so carefully, slowly. Once your investments start to bring you further cash flow, you can then use that cash flow for further investments or for whatever you're going to purchase. So you have to be very careful. You have to slowly, progressively build everything up. Like we said in the previous slide, small gains, right? Little by little, they will all add up. You don't need to try and explode and make a huge amount in a single day or a single week or even a single month or even a single year, right? Things take time. And our last slide for today is how we don't want to stick to one trading instrument. And I'll explain to you why that's important. Um, you always have to diversify your portfolio. Now, just to clarify, if you found something, if you've already found something that is working for you, right? You found a certain instrument. Let's say you you like forex and you found a certain trading style that seems to be consistently making you money, sure, sure, that's fine. Then this point is probably not for you. You're doing great, buddy. Keep it up. This point is for everyone who hasn't found that yet, right? The rest of us who might still be struggling need to hear this, because if you haven't tried everything, you don't yet know what works best for you, right? Um, I mean, maybe I trade options and I've only traded ever options, right? Maybe it's not going so well for me right now. Maybe I'm struggling. But if I haven't tried to learn about stocks, if I haven't tried to learn about forex, if I haven't tried cryptocurrencies, commodities, exchange traded funds, there's a whole pool of stuff to try out on IQ Option. We have so many different trading instruments and assets. You can't stick to one thing and just keep trying it. And if it's not working, just to kind of not try the other stuff. Again, there is a practice account, there's a risk-free environment. You can try so many different things until you find what works for you, right? And what's going to work for you is obviously extremely individual. One of the main things it always comes to in trading, in terms of individuality, is the risk to reward ratio. And you'll find in all the different trading instruments, they will have, based on the kind of leverages you can get, different levels of risk and reward. Now, I personally might not be willing to risk as much as a colleague of mine is, let's say, right? The colleague, let's say, is much more okay with losing more money as long as there's a chance of him making more money, right? So he has a higher risk to reward ratio than me. And that's completely fine. That's fine. There's neither of us is right and the other is bad, right? Sorry, wrong, right? Um, that's an individual. You have to find something that kind of hits the sweet spot for you. Now, you might find that trading stocks is a lot lower risk than trading 1 to 5 minute options, right? Because it's just so much slower. Obviously, you could potentially make a lot more money if you were to make 10 options trades within the hour, right? Than if you were to do one stock investment over the month or over the week, or even one intraday trade on stocks, right? It's still not, it still doesn't have the potential to make you as much money as the 10 options trades could, as long as all the investments would be the same. But then again, the 10 options trades could potentially lose you more money, because then that's 10 trades. Let's say each trade here is $100, $100 stock trade or $100 options trade. Obviously, the 10 trades can lose you more money. This is a higher risk, higher reward situation. You can make more money, but you can also lose more money, right? And for you to find the perfect ratio for yourself, the ideal sweet spot, you need to experiment and try the different trading instruments that are available to you. You need to try different instruments with different strategies, with different approaches, until you find something that can work for you and can give you the consistent kind of success that you are personally looking for. All right. And again, all of you guys watching this and listening to this, you should have access to an account manager with IQ Options, someone who is more than happy to help you out with finding the strategy that works for you, finding what instrument works for you. Don't ever be shy to ask for help. We are all here to help you. Um, just, you know, ask for the help and you will receive it. And you you need to try different things. It's basically the whole point of this slide, until you find what will make you happy as a trader. All right, so I think that's all for today. I want to thank everyone for listening in and for watching. Now, if you have any questions whatsoever, please again feel free to contact your account manager. If there was anything that was unclear in the presentation, do let us know. If you have any feedback for this new format where it's not live, but again, it's convenient to watch it at any time, to let us know what you think, so that we know how to prepare future webinars. As of course you are the guys watching, so we want to make it as accessible to you guys as possible. If you were interested in any of the setups I used, again, your account manager will be able to give you more detail on that. So for now, again, I'm going to thank you all for watching, and I'm going to wish you a great day, a great week, a great weekend, and we'll see each other soon. Take care.